It's my pleasure and honor to welcome you here in person and also on the screen. The title of his inaugural lecture is Monetary Policy and Globalization, and I guess the title is already a message. When we look at what politicians at the moment are saying about globalization, then they talk about rather resilience and deglobalization, and I guess we will hear that this is not the message that maybe for the coming years will be important for our economy. It's rather we should talk about spillover effects, we should talk about spillback effects, we should talk about the side effects of monetary policy that we have. I'm very happy that at the Diplomatic Academy, our professors, and especially our chairs, are here mainly for academic purposes. We ask for excellence. That's why we have chairs here for international economics. But at the same time, this is a place where policy also matters. So we always expect our chairs also to help us to get policy recommendations. And I do know how difficult this is for international economics because in the last decades, economists were not always right in the way they dealt with what's going on in the world. And this, for instance, Paul Samuelson said once, economics has never been a science, and it is even less now than a few years ago. So we'll see whether that's true. And because I prepared myself for this inaugural lecture, I have another quote by a mathematician, because of your background and interest also. And this is from James Roy Newman about 50 years ago. And he said, there have even been rumors that mathematics is used in economics, either for the deliberate purpose of mystification or to confer dignity upon commonplaces, as French was once used in diplomatic communications. That's a good quote as a Diplomatic Academy, I would say. And finally, to welcome you, I would say, I have to quote Keynes. Not because I prefer Keynes over Hayek, but because even Keynes sometimes had a good advice for economists. He once said, an economist must be purposeful and disinterested in a simultaneous mood, as aloof and incorruptible as an artist, yet sometimes as near the earth as a politician. I'm asking a lot of you, I know, but this is the place where we are asking these sort of questions and looking for answers. I look forward to your inaugural lecture. Welcome again.
A very, very cordial welcome to the Diplomatic Academy. We're truly, truly delighted to have you on board. And your predecessor was here for 35 years. So you may have a few years ahead of you. And I personally, too, I have to say, I really look greatly, greatly forward to that. Martin has accomplished a lot already. He did his master's degree in economics at the University of Vienna. Did then a postgraduate program at the Institute for Advanced Studies, did his doctorate at the Leopold Franzens University of Innsbruck, and then did his Habilitation in economics at the Vienna University of Economics and Business. And then he went out into the real world, so to say, and he worked at the Austrian Institute of Economic Research, the WIFO. He worked at FSC Financial Soft Computing, at the Bank of Finland, and then for 12 years at the Österreichische Nationalbank. His research is really fantastic, it's highly accomplished, and there are basically 3 parts to it, if I, as a political scientist, understand it correctly. There is the scholarly research, which is really outstanding. There is the policy research, which is, I think, very much informed by his stay at the Österreichische Nationalbank. And there is also a lot on methodology. So when I still used to do quantitative research, then I used a software that was called SPSS. No one uses that anymore, but now everyone uses R. And this gentleman next to me co-authored some of that I read. So he's really methodologically highly sophisticated. So for all of those reasons, we're very, very happy to have him here as a chair in economics, and we're greatly looking forward, the whole faculty and the whole DA, to the future with you. And without any further ado, I'm going to hand the word over to you.
So thank you very much, Ambassador Brix, and also thank you very much, Professor Kornprobst, for the very nice welcome. And for today, it's really a pleasure for me to be here, to meet you in person, and to give this inaugural lecture. So this inaugural lecture is actually, the way I set it up, is based on two parts. Although we had this kind introduction, I want to introduce myself once again, very shortly, based on what I've done and what I've accomplished in terms of research over the last decade. And then I'm going to talk about one of these projects, about one piece of research, ongoing research, which is about monetary policy, globalization, spillovers and spillbacks in Europe. And I try to, although there is also a lot of methodology involved, I try to keep this very short and just show you the results on spillovers from monetary policy in Europe, spillbacks, and the transmission channels of monetary policy. So, as I consider myself as a scientist, a data scientist, an empirical macroeconomist, I thought about how could I present to you and also the students that are listening online, what is my research interest, what are my research interests. So what I did here is, actually I produced a word cloud based on my publications, of course only the good ones. So these are 24 publications and 6 working papers. And I produced a word cloud which actually displays the frequency of different phrases and words that appear in this research. So sometimes I figured out that very frequently that there appear co-authors or other authors that I cited probably too much, so I will have a look at that in the future. But the other things, for me at least, make sense. So if we have this far right, if you look at the right corner on top, so this is the research that I conducted between 2009 and 2012, and actually the phrases that appear and the terms that appear are growth, convergence, catching up, regional growth determinants. So that was actually one of my research fields, looking at why some countries grow faster than others, how long does it take for poorer countries to catch up, and what are the determinants of economic growth. So if you move to the next couple of years on the left-hand side in orange, terms that frequently appear are global financial crisis, recession, determinants of recession, exchange rate, financial stress, and so on. So at that time, and you see there is already a time lag in economics, so that the global financial crisis happened in 2008, and I was doing my research on it between 2013 and 2016. But at that time, my research was predominantly focused on looking at why some countries did better in the crisis and while others did worse during the crisis. And also, this is also because of my work at the National Bank, I did a lot of work on forecasting, economic forecasting. And then, if we now go to the bottom part of this word cloud, there the terms that appear are monetary policy, spillovers, asset purchases, interest rates, term spreads, yield curve, and so on and so forth. And this is actually what I'm going to talk today about spillovers from monetary policy in Europe. So let's begin with the lecture part of today's lecture. And the first graph I want to show you is a graph of globalization measure. So we have here two globalization indices from the Corfu Institute. The red line is about trade globalization, and the blue line is about financial globalization. And we see from both indicators that we have had a steady increase in globalization, both in terms of more trade flows, and also more financial flows over the last couple of years. We have had a little dip in 2008 because of the crisis, but otherwise we see a steady increase in globalization. So what does this imply? If countries get more and more connected, if connectivity across countries increase for monetary policy. So let me start with these quotes here. So the connectivity across countries has also been acknowledged by policymakers. So for example, I have this quote here from Vittor Constancio in 2015. At that time, he was vice president of the ECB. And he was talking about international spillovers from monetary policy of one country to other economies are a corollary of globalization. Policymakers have to rise to the challenge of conducting monetary policy in the presence of these unintended side effects. So he acknowledged that for his case, the ECB, when the ECB sets interest rates or changes interest rates, this has international consequences. This causes international side effects. The IMF, 1 year earlier, took this one step further, in that the IMF said that monetary policy settings in major countries should continue to be carefully calibrated and clearly communicated, with cooperation among policymakers to help manage spillovers and spillbacks. So they were already talking about what is even more important for the policymaker, the monetary policymaker, that the spillovers can also cause spillbacks and should be considered when making the policy decision from the monetary policymaker. And that is actually also what I think Ben Bernanke in 2007 meant when he said that effective monetary policy making now requires taking into account a diverse set of global influences, many of which are not fully understood. So monetary policy making is getting more and more difficult if we face this stronger degree of connectivity across countries. So to think about spillovers a little bit more systematically, I want to show you on the next slide the main mechanism of monetary policy transmission to other countries, which is via the exchange rate channel. So think about two countries. We have one country A. Think about it as the euro area, and one country B. So the home country is country A, and the foreign country is country B. And then there is a monetary policy loosening, meaning a decrease in interest rate in country A. And hence, country A's currency depreciates against country B. So we have a currency depreciation. What happens to exports from country A to country B? Exports increase because we have the currency depreciation here in foreign countries, and so exports from A to B get cheaper for country B. And what happens in country B is a switch from domestic production to now cheaper imports, which is bad for the economy. What happens in home country A? Actually, the reverse switch of expenditure switching. So in country A, we see that imports from B to A get more expensive because of the currency depreciation. So there will be less imports from B to A and more domestic production, which is actually good for home country A. So we have for B, if we consider A the spillover sending economy and B the spillover receiving economy, we see in country B more imports and less exports, which results in a deterioration of the trade balance and hence output. So that's the main mechanism. So bad for the spillover receiving economy. This channel could be offset or partially offset if we think about why, in the first place, monetary policy is loosened in country A. Maybe it's because of a recession or the economy is not doing well. So monetary policy is loosened, and we expect this provides some stimulus for country A. So if domestic demand in country A increases because of monetary policy, then there will be in general more demand, And part of that more demand, increased demand, will also fall on export from country B, regardless whether the prices are higher or not. So this is called the income absorption effect. So we have these two effects, expenditure switching, which means that output is negatively affected from this monetary policy loosening expansion in country A, and it could be partially offset by more domestic demand, GDP increase in country A, which falls also on exports from country B. But that we don't know. We have to estimate it. Now, this is the main mechanism of the exchange rate channel. Now we can think about how globalization might have altered or modified this channel. So now we can think about different effects from globalization and why this affect this main mechanism of monetary policy transmission. So one is higher financial globalization, as we've seen before. So this has an effect on currency values. So basically, the exchange rate responds more strongly if the interest rate is cut. This is because there are a few countries, only a few countries with capital controls. Capital can move freely, so we have more responsiveness of the exchange rate if interest rates are changed. And hence, this channel works more strongly than without financial globalization. We can also think about net foreign currency exposure effects. So if people abroad hold, or in this case, if people not living in the euro area hold wealth denominated in euros, and then we have this exchange rate move, then they lose wealth and are worse off than before. So this is a net foreign currency exposure effect. And then we can think about trade and trade openness, and here there are two things. So first, if we have an increase in trade, if you have an increase in bilateral trade, so a non-euro area country with the euro area, of course the spillover effect will be stronger. But in general, if we talk about trade globalization, we're talking about diversification of trade. So trading, not only trade towards one particular region increases, but in general trade to other countries, and in the case of Europe, and if you look about the euro area and neighboring countries, also the neighboring countries trade a lot among themselves, so there is a lot of trade globalization going on, and this is a diversification, so to say, of risk to get negative spillovers. Again. Oh. I'm okay here. No. Now. There are also some factors about globalization that can amplify the spillovers. And I just want to pick, so if you narrow it down now, if you think about country A as being the euro area and the spillover receiving region, neighboring countries from Central Eastern and Southeastern Europe, then we have actually two things that are really important. So one is the research about invoice currency. So before, we assumed that exports and imports are always invoiced in the currency of where the firm is located. So now what actually is true is, if you consider Europe, the euro is a regional dominant currency. So this means that, for example, if a euro area country trades with, let's say, Poland or the Czech Republic, the exports and imports are actually invoiced in euro. And then, if this is the case, then if the euro depreciates, because we have this monetary policy expansion in the euro area, then there will be no drag on exports from let's say, Poland or the Czech Republic, because these are invoiced in euro. So actually this is a good thing for these countries. And also, and this is very particular for this region, we have strong cross-border financial flows between globally acting banks located in Austria or in Western Europe, and that have their parent bank, that have their branches in Eastern Europe, for example. So if interest rates decline in the euro area, then these banks can get cheaper funding in the euro area, located to their branches in Eastern Europe, and they can lend it out to households and firms, which again spurs economic growth. So we have these positive factors that could amplify the spillovers. We have also some other things regarding the expenditure switching channel, which I'm going to skip now. So that is about why globalization could change actually the transmission of monetary policy to other countries. So what does the literature actually say about spillovers? So this is a short literature review on spillovers from the euro area to Eastern Europe, and you see this a very recent literature. And what we see from this literature is actually three facts. The first is all the studies find positive spillovers to output and inflation. Second, these spillovers are actually very large because they are similar in size to the domestic effects in the euro area. And third, that some part of these spillovers actually come from third countries. So it's not only the direct effect, euro area to a neighboring country, but also then these neighboring countries are affected through other neighboring countries that are also affected from the euro area monetary policy easing. So what I'm doing is ongoing research. And what I want to talk about in this lecture is actually about these 4 points very briefly. So the first thing is actually relating to this literature review slide we have seen before. So again, we want to quantify the spillovers, the magnitude of spillover effects from euro area to a neighboring country with a focus on these Eastern European countries. We have a new methodology, we have a new model, so we want to see how the effects change if we use this new methodology. Points 2, 3, and 4, they are new, they contribute to the existing literature. So we want to see also through which channels monetary policy transmits, so how these countries are affected. And then we want to see whether we see a rise in the strength of spillovers, maybe due to globalization, as we've pointed out before. And lastly, and this is very ongoing research, we want to see whether we also find evidence for the flip side of this. So whether we find evidence in the data for spillbacks, so effects that arise from spillbacks from the Eastern European countries back to the euro area. Okay, so now, first, before we look at the results, we have to think about how we can measure monetary policy. So mostly monetary policy is described by this equation here. So we have interest rates on the left-hand side, and then interest rates are set according to a feedback rule and a shock. So the feedback rule, a very famous feedback rule would be, for example, a Taylor rule, so that the monetary policy maker sets interest rates when looking at inflation or the output gap. So these two factors, output gap and inflation, would be part of this information set omega here. We can think about other things that the policymaker looks at, for example, at movements in the exchange rate or other indicators of financial stability, or maybe in the future about indices of globalization. So what we want to do is now we want to estimate the effect of an interest rate change on output. And the problem is that output is also part of the information set of the central banker. So in economic terms, and the homogeneity problem arises. We want to assess the effect of an interest rate change on output, but we have to distinguish it from the systematic reaction of the central bank to a change in output. And this problem is called identification in econometrics. So we have to isolate the so-called exogenous part of monetary policy from the feedback rule. This is actually given by this term here. And to do that, we borrow strength from a very recent paper that came out in 2019 from colleagues of the ECB. And what they did is that at each meeting of the ECB Governing Council, they collected asset prices and interest rate yields before the monetary policy decision and after the monetary policy decision. So assuming that in this short time window between this short time window, which is about 2.5 hours, that no other effects than the monetary policy decision can affect asset prices and interest rates. And with this information, they construct an indicator that measures the pure effect of monetary policy, or can measure the pure effect of monetary policy. Of course, they had to do some data cleaning because other things occasionally could happen during this time window, another central bank announcing something, or other things could happen. So they had to really look at each decision of the council and had to clean the data. But these data are freely available and can be used to measure the exogenous part of monetary policy, and can be used now to measure the effect on neighboring countries. So you get this time series from this paper, and then you can collect macroeconomic time series for the countries of interest. So in this project, we are interested in spillovers from the blue area, the euro area, to neighboring countries from Eastern Europe in orange, and we also include some more advanced economies here in red, as well as the data for the United States to control for some global factors. So for all these countries, we collect the following set of data. We have this monetary policy instrument, which I talked before, from these colleagues of the ECB. And then we have some global control variables like the commodity price index and the VIX, which is a stock volatility index. And then we collect this macroeconomic data, industrial production as a proxy for output, consumer prices, short and long-term interest rates, the exchange rate, equity prices, and another risk indicator for all the economies we're interested in. And then we have to model the joint dynamics of all these variables, and the econometric framework we use is a vector autoregressive model. And this vector autoregressive model is basically set up into two parts. So we have the monetary policy indicator, then we have the euro area variables, and then we include on the bottom the variables that we are interested in, namely from the spillover receiving economies. So we do this 10 times for each country. We set up a model with these two blocks. The first block is always fixed, and then the second block varies with the country we are interested. So we have 10 CZ countries, so we estimate 10 different models. And we're interested in the effect of this MP variable on the spillover receiving economies, controlling for all the other variables in the middle here, in between. The way we do this is we use a very new econometric approach. I'm not going into the details here. The only thing that I want to stress is that these coefficient matrices A and Q, they have a little subscript T here. So this means that they can vary over time, which should capture the changes in relationships among the economies and also between the variables we consider. This is especially important if you have a data set or a time period which is very volatile. And we consider data from 2003 to 2018, which covers the global financial crisis, which covers the sovereign debt crisis. And especially if you would do this analysis now with the data on the pandemic, you would see at the end of the data sample a dip, a very strong dip. And it's very important that you use then a flexible model that can handle this kind of spikes in the data. So the kind of results you get from this analysis is shown on this graph. So here we see the domestic responses in the euro area to a monetary policy loosening, where we capture monetary policy by using this instrument that I've explained before. So what you see here is actually, because we use a time-varying parameter model, we see for each point in time, for each point in our sample from 2003 to 2018, we get a different effect and a different response. And we have colored the different time periods, starting going from very yellow to, at the beginning of the sample, to more and more dark red at the end of the sample. So what this means is, for each point, we can get a different response of monetary policy on output and inflation in the euro area using this model. And actually, these things here in black, these are the effects where we look at the average over time. So this is, let's say, this is an average effect over time here, the black line here. And then you see for each point in time a different effect. So two things are worth noting here. So first, we have a positive effect on output. So these effects are positive and also significantly positive, and also on inflation, and also on equity prices here. So which is actually a good thing, because then we know that our model behaves as we would want the model to behave. We have a monetary policy losing, we want to have positive effects on output and inflation. The other thing is that we have this strange behavior here in orange. So we have very strong effects in orange on output, on inflation, on commodity prices, also on the other verbs and equity prices. And you can guess which period this is, because I said 2003 is very yellow, and then it gets darker and darker. So these orange lines correspond to somewhere in the middle of the sample period, which is actually here in 2008 and here in 2010-11. So this is what you see. Here are the effects of monetary policy over time for different sample periods. And what you see is that monetary policy is most effective in the euro area in stimulating output and prices during these two episodes, the financial crisis and the sovereign debt crisis. And it's also the case for equity prices. And this actually relates to very recent literature that looks at the effectiveness of monetary policy during episodes of financial stress. And there are some reasons why why monetary policy is in particular effective during periods of high uncertainty and financial stress, which was the case in 2008 and also in 2010. So this was about domestic effects. It's the same with spillovers. Also the strength of spillovers is stronger during these periods. But I'm not going to show you the results for this, because if you look at each of the 10 countries and all the results for all the different variables for all the different time periods, it's very time consuming. So what I'm going to do with regard to spillovers is I'm going to show you the time averaged mean effects over this sample period, and also I'm going to show you only the peak effects. So this is the maximum effect, the maximum spillover of euro area monetary policy on output prices and equity prices in this region. And what you see is first the effects are positive. So what I did is also in gray, the gray bars denote not statistically significant results. And you see that for most countries, the results are significant, they are blue. This is the case for output, also for prices, and also for equity prices. And you also see some kind of cross-country heterogeneity across these countries. So for some results, you have some nice stories. So output is more strongly affected in Hungary, Czech Republic, Poland, Slovakia. I would say these are the countries that are most strongly integrated with the euro area. Also for prices, it makes sense because we have these countries that anchor their currency on the euro, like Bulgaria and Croatia, but also countries that showed in the past very volatile and high inflationary data, like Romania and Russia. And for some other variables, you don't have a clear story, but you see that all the effects are positive. You have positive spillovers on output prices and equity prices. And if you go to the next set of results, this is about exchange rates. So a negative effect on the exchange rate actually implies an appreciation of the local currency against the euro. So this is actually what we would expect. So these currencies appreciate against the euro. These appreciations are particularly strong in Turkey and Russia, but also in Poland and Hungary. These are countries that have used the currency and the exchange rate in the past to buffer shocks. So there's a lot of volatility in these exchange rates if you look at these countries. So they show a strong response. And then we see a more mixed picture on short rates and long rates. So basically they follow the euro area monetary policy in the sense that they also ease. So short rates decrease, long rates decrease, but the results are not as precisely estimated. For some countries, we do not find significant effects on short rates and long rates. So this was the first part. This was actually re-establishing findings from the literature. And now we want to go a little bit deeper and think about the transmission channels. And one way of doing this, using this method of and using this econometric framework of vector autoregressions is by using counterfactors. So we can decompose the total effect of monetary policy on a response variable, let's say output in the Czech Republic, into its direct and indirect effect through other variables. And then we shut this indirect effect down, we set it to 0, and see what happens under this counterfactual analysis. So this is a way to measure the strength of a certain channel that we are interested in. And we are going to look at actually at the channels listed here. So we are going to look at what happens if we shut down euro area output as a proxy for the demand channel. What happens if we shut down the exchange rate channel for a proxy for expenditure switching. And then we also want to look at what happens if we shut down output from other CEC economies as a proxy for second round or third country effects. And the results are displayed here. So how do you read this chart? In black, the black lines always reflect the unconditional effect. So if we do not shut down any channel, and then you see the counterfactuals. And if we first look at what happens if we shut down the euro area demand channel, so no euro area demand, then you see that in most cases this line, the red line, is smaller than the black line. And in some cases, the differences are actually very large. So this means if we shut down euro area demand, the spillovers would be much smaller, which by contrast implies that the demand channel is very important for the overall spillover. The overall spillover consists to a large degree by this euro area demand channel. Then we can do the same for the second round effects. So they are in blue, these dotted lines here, these blue dotted lines. So these are effects that, for example, we look at spillovers from the euro area to the Czech Republic, but there might be also some spillovers from other countries that the Czech Republic trades with. And these are called second round effects. And if we shut them down, we see that again, the blue line is much smaller than the black line in most cases, which implies that this is a very important channel if you want to look at the spillover transmission. So we have two very important channels. One is euro area demand. The other one is second round effects. The last one is actually if we shut down the exchange rate, and this is given by the orange dashed line. And here we see actually not a big difference in most economies between the black and the orange dashed line, which means that the exchange rate channel, at least compared to the demand and the second round channel, is not as important. So if you want to quantify a euro area monetary policy transmission to these economies, the most important factors are the increase in euro area demand in output and second round effects through other economies. So now, and this is also the last part, we want to look at the flip side. We want to look at whether we find evidence of spillbacks, and we can actually use the same model and we can use the same methodology to look whether we find significant spillbacks, and we can again shut down different channels to pin down these spillbacks more precisely. And this is the picture we get. So here I aggregated all the CEC economies in one basket, because it's very unlikely that one single country produces significant spillbacks to the euro area. So I aggregated them all in one basket, and I'm looking at spillbacks from the CEC region to the euro area. Sorry. So what we notice is actually first the effect on euro area output. The black line here is positive, and then if we shut down, if we want to see the effect that comes through demand from the CEC economies, we can look at what happens if there are no exports, imports, or to the CEC region, as well as more generally actually we can look at what happens if we shut down demand from the CEC economies. And this is actually the red dashed line here, and we see that the spillovers, the spillbacks to the euro area would be significantly smaller if you would shut down this channel. So we have significant spillbacks using this analysis also from the CEC economies. And this brings me to the last part, to the conclusions. What can we make out of this analysis here? So first, I would say two things. So first, we have seen that spillovers from euro area monetary policy to CEC countries are significant. They are positive. And the question arises then if this is a problem or not for these economies. We're talking about monetary loosening in the euro area. So these are positive spillovers to the CEC economies. And then you could ask and say, okay, but why should we bother? These are positive, these are stimulating, these are extra stimulus to growth in these countries. But the problem arises if the business cycles of these two regions are not synchronized. So if they are maybe in a boom phase and you provide additional stimulus, then this is not something you want as a policymaker in this region. Now, with the pandemic, so everyone is in a recession, so it's not a problem. But before, we have seen tendencies of tight labor markets, in strong wage growth, inflation growth in these countries, indicating boom phases, and we didn't see that in the euro area. So there was a little bit a desynchronization of the business cycles between these two regions. And if this is the case, then spillovers can be regarded as unintended side effects. This is the first part. The second part is, well, we've also seen some evidence for spillbacks. And this is even more important for the policymakers in the euro area because they have now to think about how should they factor in these spillbacks in their decisions. So should they modify their policy rules? Should they consider other factors than domestic inflation and output? Should they include these global factors, some global factors that are not well understood? Can they come up with some measures? And this is actually what is currently also discussed at the ECB. It's not only this point, but the ECB has its strategy review for the first time for many, many years. So they're rethinking about their policies, about everything, about 2% inflation target, about policy rules, about globalization. And this is something that is currently discussed and is, there's an ongoing debate about it. So I think this covers also the policy implications of this research, and many thanks for your attention. And I would like to stop here. Thank you.
Thank you very, very, very much. I greatly enjoyed this talk from the beginning to the end, actually. The beginning, I thought, was a really fantastic way of summarizing what you've done thus far with the word clouds. I thought it was very creative and very concise at the same time. And there was obviously then a talk following that was highly, highly sophisticated and methodologically very, very sound, very rigorous. Don't feel discouraged to ask questions because of that, but feel encouraged to ask questions. No matter what kind of questions you're going to ask, whether it's about something in the word cloud or whether it's something about a very peculiar part of a very peculiar formula, or whether it is something about the policy implications, all questions are welcome.
For me, it was fascinating. I'm concerned about policy implications you're talking about here, because you shied away from saying how the real world is making use of these implications. You said that the ECB is discussing it at the moment, but what are the real discussions there? Could you say something about which countries would like to accept that we have also to include unintended effects in our policy making? Could you say something about what is the position of the Austrian National Bank in these discussions? I'm not sure whether we are allowed to say this, but give us a flavor of the Austrian position on unintended consequences, thinking about spillbacks, including in monetary policy and these sort of things, if you may.
So you could say One thing is more cooperation, more coordination. So like the countries should more cooperate more strongly, but you also have to say that the mandate of a central bank, and this also applies to the ECB, is a domestic mandate. So this is a fact. It's a domestic mandate, so they have to mostly care about domestic developments and not about international developments. And then there's another thing you could do to mitigate spillovers, so not only more cooperation, but you also could say that, and there's literature on it, that you should, so to say, put your own house in order, so that some countries that are especially vulnerable to negative side effects, spillovers, are those that show some vulnerabilities, that don't have sound macro financial data, and there's this literature that says, okay, these countries have to put their house in order, and then they will not receive adverse spillovers. So these are the two things. And
Austria?
I think Austria would say a central bank has a domestic mandate, and that's the view in from Austria.
If you would do research, so you dealt now with a bank that is regionally dominant. I think that's how you put it. What if you would do research along those lines on a global level? How would you, in terms of the order, how would you conceptualize that? Is that so with the Fed and everything? What kind of a system? What kind of a concept is there for that? And is it then that these main banks, that they are kind of interlinked to some extent, so creating some kind of a, however unstable order, and the others have to go with it? Or is there a considerable amount of friction amongst them?
I think there's a lot of research on spillovers from the Fed. Actually, it's the biggest part of spillovers is spillovers from the Fed. So that's really a US dominant kind of research. And the US economy drives the global cycle, especially the financial cycle. So this is the driver of the global financial cycle is the US economy, and the US economy, what the US economy does is also influenced by the Fed. So the Fed is very relevant to drive the global business cycle. And it's also true that what you said, I said the euro is a regionally dominant currency, and there's a lot of especially in that area, there's a lot of research going on at the IMF, at the fund, because that's the topic of the head economist, Gita Gopinath. She's really into this invoice currency. And while we have the euro as a regional dominant currency in Europe, the global dominant currency is the US dollar. So the US dollar is also involved in trade between countries that do not involve the US. Whereas in Europe, the euro is only taken as an invoice currency if one of the counterparties is from the euro area. So there's also the global position of the US economy also in this kind of the literature. So.
Thank you. And Tom Rowe, I think you were next. Yeah.
Martin, thank you very much for your talk. I wanted to ask how you see the present situation. I mean, the COVID moment, so to speak. Because if I understand it correctly, on the one hand, we have a huge collapse in euro area demand. So that's really fallen. At the same time, we have an expansive monetary policy in the euro area, if I've got it right. So what happens when you have a collapse in euro area demand with an expansive monetary policy? What are the spillover effects in this present COVID moment?
The way I see it, the COVID period is not a thing where we should look at spillovers also, because I think that is really something where fiscal policy and the countries should do something on their own. It's also in the past crisis in 2008, I think a lot of pressure was put on the central bank to provide stimulus, while the countries had been more and more reluctant to provide fiscal stimulus. And I think it should be always the case that both of these policymakers work in the same direction if there's a severe recession. And in the global or in the COVID pandemic, I think stimulus should now come more from the fiscal side, if there's fiscal space. Yeah, so if you have some room for maneuver. And I think at the same time, the policy space on central banks gets smaller and smaller and smaller. So we have already zero interest rates. In some countries we have negative interest rates. We had these large asset purchase programs, quantitative easing. At some point in time, policy space erodes, and then other.
Fiscal policy.
In my opinion, fiscal policy would help getting out of the recession.
See, we get Keynes after all.
Anyone else? Yes, please.
So I had a question regarding spillback effects. I never thought of that before, but how does that impact the domestic mandate that you responded to in the first question? So do they think about, well, at least the graph that you showed us had some lowering output and then an increasing output. I think you just showed us output, but I don't know, regarding the other parts of the mandate, are those included in the decision making? Should they be included in the decision making?
The way you put it is the spillback actually affects euro area demand, and euro area demand is part in the information set of the central bank. So in that sense, it's captured. But I think the problem is in timeliness. So when you make a decision, you have to have the most recent indicators, and you should think about, before you make the policy move, what could happen, and you should put that into your decision. And that's not in the information set. Although then with the time lag, if output in the euro area is affected, you're right, then at the end it's there. But I think this is the problem of timeliness.
Martin, thank you very, very, very much for a great talk. I really learned a lot. And thank you for being here in a little bit of a strange, very small setting. Under normal circumstances, it would have been many, many, many more. Nevertheless, thanks a lot for coming. And and you have many, many more talks by Martin Feldkircher to look forward to in the years to come. And please come back. Thank you very much.